Will we swing for the fences at times? Yes, but we're more, like the great gold rush. Do we always go for the gold? Well, there's a lot of people that made a lot of money in the picks and shovels and the jeans along the way.
Today, I'm excited to speak with Bill Cariss, CEO of Holman Strategic Ventures, a powerhouse investment firm shaping the future of automotive technology. We dive into how he's strategically investing $9 billion in auto tech and beyond, his biggest wins and setbacks, and discuss companies that are red hot right now. A big thank you to our sponsors for making today's episode possible: LotLinks, Uber for Business, and CDG Recruiting. And now let's get into the show. Bill Cariss on the CDG podcast. Bill, welcome.
Thanks, Yossi. Great to be here. Your reputation precedes, so an honor to be on the podcast with you.
My man, appreciate you coming on. We finally made it happen after a couple of delays, so it'll be a jam-packed conversation. I'm pumped for it.
Can't wait. Let's do it. You're not that far from me. We're about an hour away, so can't wait for this.
I actually obviously I know Holman pretty well. Your organization, growing up in the just vicinity, but it was one of the operations that I admired from afar and never had a chance to really explore, tour it. I used to try to get to just go observe all great dealerships nearby. I remember taking a tour at Auto Lenders, so that was very interesting. They really inspired a lot of the just early days what we did on the used car side, because they really systematized it really well and just created a machine, vertically integrated reconditioning. But I'll hopefully learn a lot about Holman today and how you guys run such a tight ship and have scaled tremendously. But before we get into that, I would love to tell us a little bit about yourself. You are someone who was working in the dealership operations, and today you run Holman Ventures. So very interesting path. Typically you see people go from, in store, whether they're physically in store or, working with in-store teams, but in store to like the vendor side. You went to the venture side. So quite a atypical path, but give us your story.
Yeah, sure. Happy to do it. So, happened quite a while ago and started out actually on the fleet side, believe it or not. So I think, with Holman, we have several verticals now that we can get into, but our fleet management business is where I started my career. I won't tell you how many years ago, but it was quite a while ago. It was actually 40 years ago I started there. That was when ARI, we're called Holman Fleet now, but ARI had all of about 48,000 vehicles under management or lease. Spoiler alert, we have 2.2 million vehicles now, so we've grown just a bit over that time. But started off here in Maple Shade, New Jersey, and started off in a sales support role as a freshly minted college graduate, and did that for about a year and a half, and then a job opened up in I guess we used to call it sales back then, now business development. And I moved out to Southern California, spent 9 years there. Both my kids were born there. By the way, I met my wife at Holman, so it's kind of a very all in the family. You see a lot of that at Holman. So yeah, and still the same wife, still great. 2 kids. They just got married last year, but yeah, back to career. 9 years in Southern California. Had a nice promotion, moved to Seattle. Started up a sales office for ARI there, and then I got a phone call from Mindy Holman and said that she and her dad wanted to meet with me. And fast forward, they asked me to come back on the retail side, and that's where I started my retail career. So spent 5-6 years learning the business, selling cars, AGM, GM, doing all the normal rites of passage. And then lo and behold, it's 2001, I became the vice president of operations for all of our dealerships, and then the president for all our dealership groups. So 18 years of doing that. Had a blast. Love retail. People always say to me, if you'll know you love retail within about 2 days, and if you're not sure, then you probably should find somewhere else to go. And I say that to youngsters now, like it's something you either love or don't. And I certainly did love and still do love retail. We went through, this is 8 years ago, we had just brought on the Cooney Group. That was a super fun acquisition for me. A lot of relationships we can talk about in there, but we were absorbing them and integrating them in. And we went through a couple of changes in leadership, positive changes. We're really big on that, is having people go into different roles. And so I was asked to take on this thing that we didn't even know what to call it, but leading strategy, leading our venture group. I had a group of about 25 high-end developers that reported to me. And the whole mission, Yossi, was this. It was, how can we keep Holman relevant for generations to come? So I said to my then boss, our CEO, Carl, and a good friend, I said, are you kidding me? Like, that's the mission. That's a big one. But that's what we set out to do, is how do we do that? By investing and building platforms. So been doing that for the last 8 years, and it's been an absolute blast to do.
Okay, so the idea behind your role today, like you said, is you are trying to create a long-term durable business, and doing that by investing in the future technologies that will drive the dealership business. Is that a fair assessment?
Yeah, I would say the only thing I would add to that is not just the dealership business. So as you know, Holman is comprised of many businesses, but three main operating verticals. Retail is the second largest of the three. The largest is our fleet and associated fleet businesses. Yeah. So again, we're good-sized dealers, just under 60 dealerships, and many of them are quite large. But our fleet business is still the driver in overall profitability and size of our businesses. Our third, we do a lot in manufacturing. We have 11 upfitting and manufacturing truck plants around the country. That was a distant third up until the last 3 to 5 years, and that's all of our businesses are growing, but that one on a percentage basis is growing the fastest. So come back, it's not just dealerships. We do a lot in the IoT space. We do a lot in supply chain. We just made our second investment in autonomous mobile robots. Obviously, supply chain and warehouse management, there's a big application. So we love being a dealer. As you know, we've bought Leaf, and we spent many millions to continue to be a dealer, but we love the other businesses as well. So a little wider swath of investment.
What was first? Did you start as a dealer group? Was that was the beginning?
Correct. Yeah.
So it makes me want, do you see this as a potential playbook for other dealer groups in the future? I think we are at a time where uncertainty, just in the macro, is higher than it's been in likely decades, way before I was born. With the changing, types of vehicles, to the changing consumer demands, and just, technology, AI, with OEMs and the agency model, and some OEMs trying to get closer to the consumer. All these things happening, right? Dealers are looking to diversify, and the quick wins, or like the obvious things, are let's horizontally integrate, or let's go into power sports, or some, adjacent business, expand our collision centers, right? These are a bit more obvious plays, but what you have accomplished is or Holman organization is very, I would say, non-traditional, right? You've gone into fleet and manufacturing, which is it's just not a term I would expect to hear in the same conversation with someone who's traditionally a retailer. Frankly, I don't know if there are any retailers who also have a manufacturing division. You would know better than me. Do you think that this is an actual applicable playbook for the rest of our industry to scale? Or do you think that this was pretty unique to the Holman organization? I'm just curious to know your general thoughts here.
Yeah, I don't know. That might be a little bit of a stretch. And so maybe just, give some historical context. So we're celebrating 100 years. We started in 1924 as a single point Ford dealership here in South Jersey. We grew that business quite a bit. 1948 is when we started our fleet business. And I think this might be the theme that you'll hear from us. That business grew out of our partnership with Ford Motor Company. Ford came to us, like many dealers. We had, the back office, little leasing desk, if you will, in the showroom. So we had multiples of those. And Ford came to us and said, hey, this company called RCA, which was here in South Jersey, needs to lease 100, what they called panel vans back then, cargo vans. So they said, how about if we help you with this, and let's partner with this? We leaned in, we did that, and that was the first fleet that ARI, which is now called Holman Fleet, started. It really is a story of partnerships and opportunities is how I would define it. So Ford started us down that path. We had other businesses that, we have long-term relationship with companies like FedEx. That's a 42-year relationship. FedEx asked us in Fleet to do some what are now products that we sell at mass scale, but custom products for them. And what we often would say is, listen, if you lean in with us and partner with us, we'll build this, but you have to be our partner. This isn't a vendor relationship, it's a partner relationship. So that was a very significant play that we did with FedEx. We've done a lot with heavy railroads. Burlington Northern is a 40 plus year relationship. And they were one of the ones that got us into the manufacturing. And so we were very heavily, still are, in upfitting trucks for rail applications. But a lot of it was driven by either partnership opportunities or partner clients who said, let's work on this together. So yeah, is it a playbook? I think the playbook would be more, it's not defined by let's go into manufacturing or let's go into fleet. It's let's keep our ears open and satisfy clients' needs. And if we can create a win-win, let's do it. That would be more the playbook that I would define it as.
Yeah, solutions oriented. I received a text message yesterday and someone who I respect, smart person, they said, hey, imagine if the public dealer groups teamed up and acquired Stellantis North America. I was like, okay, retailers going, they're in trouble, but it was just, got me thinking like really big and wide, far and wide. So
this episode is brought to you by LotLinks. Dealers, when you look onto your lot, do you see risk? Every day, almost half of a dealer's inventory is at risk of aging. That's an average of a $1,500 hit on your gross profit per vehicle. But savvy dealers can avoid risk and get that money back. Introducing LotLinks Sentinel, the first and only AI inventory management solution completely focused on predicting and mitigating your carryover risk. With a decade of machine learning optimization behind it, LotLinks Sentinel allows dealers to launch separate strategies for each individual VIN and ensure they sell faster and more profitably. All this so you can turn cars 7 to 10 days sooner and protect your margins. Stop accepting unnecessary risk and start controlling your inventory. Get the LotLinks effect with LotLinks Sentinel. Visit lotlinks.com/sentinel to learn more or click the link in the show notes below.
Anyways, I want to transition to retail because I think that you have a lot of really unique insight here. And I just want to start with, you are on the front line of, just cutting edge technology within our industry, but also, where are we headed, right? You have the retailing business, which you have all that first party data, right? You're seeing what's happening on the ground floor. You're not relying on external dealers. Just start us off with what are some general themes that are top of mind for you, for the organization, in terms of technology, innovation, right? Where the auto retailing and digital dealership business is evolving. What are you paying attention to?
Yeah, so I think the theme there would be, and one of the things our current CEO, Chris Conroy, says, and I love this, is we want to be known as a company that is easy to do business with and easy to work for. So technology is a huge driver in that. One of my good friends and colleagues, our CIO, Jared Phipps, is I say this in a very positive way, is just an animal about data. Like we have this treasure trove of data, which is where you're going. We have these applications, we have these relationships. What are we going to do with it? And how do we become easier to work with and work for? So, you look at things, obviously AI is all the rage, and you look at what's going on. There's some startups that are doing some really interesting things in that space. I think some of them are going to succeed. I think there's going to be a lot of consolidation of those. So we're working with some of them. Honestly, we haven't invested in one yet because we're still not exactly sure. Well, we know this is going to change incredibly quickly. It's beyond, what Andy Grove thought of with Intel, with the duplication and just, you get in the Wright's law of manufacturing. It's going to change dramatically. So we are involved with AI as it relates to data, but I would say data is the key to what we're looking at right now. What do we do with this? How do we serve it up at the right time, at the right place to not only our customers, but to our internal Holman partners so that they can satisfy our customers? When you look at retail, Yossi, I remember when I first got involved in retail, and it struck me, this is, 25 years ago, and spending time in the dealerships and being a new car manager and a GM, it always struck me how incredibly busy it can be for spurts of time and then not so busy. And how do we make our people so productive that they can handle, this influx of business as it occurs in retail? You look at what goes on in the service drives, people dump off their cars first thing in the morning and pick them up at the end. And how do we handle all that? So we've spent a lot of time looking at workflows and how do we make our people more productive while allowing customers to engage when they want to engage digitally, to jump out of that, the omni-channel, and then jump into a personal relationship as well. We're still on that road. It's come a long way from 25 years ago, but I would say we got a long way to go still. There's still a long way to go to really provide our internal partners with the tools they need to satisfy customers.
Give us a little state of the auto tech market. 2021, I've spoken about this on prior podcasts, was just insanity with everything, valuations, access to capital, right? The market shifted pretty suddenly and rapidly. That went away. What are you seeing in the market today? Are you still seeing, are you seeing a similar level of startups and innovation and, entrepreneurs trying to tackle just day-to-day dealership problems? What has changed? Give us a little sneak peek of just what's actually happening on the ground floor.
Yeah, I would say it's a really good story. And supply and demand pretty much dictates everything. And right now there's a really nice supply of capital that can be deployed through investments. So founders will follow ideas first and foremost, but they need capital to grow. And let's face it, in the last 3 years, it's been a very nice profit season for OEs, for dealers, primarily for dealers as well. So there is a very robust amount of investment sitting on the sidelines or deployed. And a lot of that is dealers that are very interested. There's obviously some very successful automotive VCs too. I know you've had several on your podcast here. We work very closely, and we can talk a little bit about our relationship with FM Capital, what we're doing there. We also work very closely with the other automotive VCs. So Fontanalis, those guys are great friends. We love Autotech Ventures, Steve Greenfield. That whole group we're very, very close with. And just as significantly, the corporate venture capital groups that have sprung up. We have meetings all the time with people like CarMax Ventures. We love Terrence from there. Goodyear Ventures, Abhijit Cummins. There's so many. General Motors Ventures. We spend a lot of time with those corporate venture capital groups. There's probably about 14, 15 that we have monthly calls with, sharing deal flow, sharing ideas. So it is a very robust time of investment in the automotive space driven by that capital. Obviously, valuations have moderated. Some people would say it's cheap. It's not cheap. It was.
What are valuations? Like, give us some rough parameters right now.
Yeah, it depends on if you're a real SaaS deliverable. A true SaaS, and true SaaS means your margins are in around that 75, 80% gross margins. These aren't 20% gross margins. A true, not tech-enabled, but SaaS model, we're still seeing multiples on revenue at least 6 to 8 times. They were 15 to 20 in the heyday a couple years ago. And depending on what you're delivering, they can go nicely above 8 times as well. But that 6 to 8 seems to be the sweet spot for a good SaaS product. AI, if you are a true AI company, not just a SaaS deliverable, obviously those multiples are higher, and you can still get into the teens. And I would say, and we're, again, very interested in and invested in 2 robotics companies. That's another red hot space. And they're easily into that low double digits multiples of, and When I say revenue, annual recurring revenue, true annual recurring revenue, not transactional, but true annual recurring revenue. So you have to be, it sounds like you know the space pretty well. You have to be very descriptive and succinct when we're talking about that because it's not just revenue.
Yeah. Yeah. I mean, people put, gross merchandise value as ARR, and it gets pretty hairy. I have a follow up on that. Before we move on, you mentioned dealers investing in venture. What's your general take on this trend? A good thing for the industry, kind of indifferent, bad thing. It's something that has, again, grown in popularity over the last, I would say, probably, decade, maybe 5 years even, to be more specific. What's your general take on the trend?
I love it. The reason I love it is good dealers are so invested in this space, and dealers are taking some money off the table from their dealerships because they can. And obviously, we have facilities to invest in, all that. They're investing in the future of our business through these technology investments. So I love that. I think it's super healthy. Is it fraught at times with people not quite knowing how to invest? Of course. But that's where I would say there's so many of us on the corporate venture side. And then some of those VCs that I talked about, there's some really, really solid professionals on the financial VC side and the corporate venture capital side. I get asked to speak quite a bit, and invariably it ends up leading, after I speak to a group, to at least one or two more groups that say, hey, can we just call you and see what you're doing? And the answer is always absolutely. Let us know. So I think it's tremendous. It's going to make our business better in the future because of the investments dealers are making.
Why do you think dealers are doing it though? Right? Like, is it driven by, self-enrichment, or which, many dealers that are doing this are pretty wealthy, or, sitting very well, or is it more driven by being close to what's cutting edge and being able to, like, hey, I'm enabling this software from succeeding. I want to have a piece of that upside. What do you think is driving the interest by dealers in investing in tech?
Yeah. So, I hate to speak for everybody, but in general, it's B. Most dealers. So for instance, when we started our corporate venture capital group, we said, what do we want to be? What do we want to do? And it was really, really important that we I like to say we defined our own internal lexicon of terms for Holman. Like, what does strategic mean? So we literally came up with strategic growth, strategic operational. Strategic operational for us means better, cheaper, faster. That's great, but we love strategic growth at Holman. Strategic growth is, could this be a new business? Could this be a robotics business? Could this be an IoT business? We're seeing similarities with other dealers saying, I want learnings and optics into technology in our space that could change our space. I want to be a pilot for these companies. Do they want to make money? Absolutely. Just like Holman, we're not doing this to, have a many $1 million write-off. That's for sure. But does it matter if it's a 20% IRR or 14% IRR? Not really. It's really this more strategic play that we're looking at. And most of, if not all of our dealer friends are looking at it for the same reason. They know it's risk capital. It's way riskier than buying a car dealership. That's for sure. But they love it for the strategic side and they want to invest. If I can add to that, we're right now, and we'll talk a little about our partnership with FM Cap that was just announced. One of the things that I'm working on with Chase and Mark there is to build a mentoring coaching group. And what we're doing there is bringing other dealer friends in to help with that. And the response to that's been phenomenal. I mean, dealers just love helping mentor coach these, and they don't have to be young founders. Some of them are, my age. Some of them are, not all in their 20s, but new to our business. So that's been a very attractive piece for some seasoned dealers.
Yeah. So Chase Frazier, founder of FM Capital, he does auto tech investments. He's been on the podcast before, phenomenal operator. And you made a minority investment in his fund. What drove that decision? Why did you decide to do that?
Yeah. So we, back up, we've been an LP in their fund 3, fund 2 and 3. And then we just became a small minority GP in fund 4. So to answer your question, why do the GP stakes? really comes into a bigger picture for Holman. We, say this humbly, but we like to do things at scale. And so we've been doing this investment practice, if you will, for the last 7 years. We decided that we want to really, we want to grow it. We want to grow it in a significant way so that it becomes a full business for Holman. And that means more investment, some ownership. And so really, this was the first of the ownership stakes that we're looking to take as we build out not only VC, but also some private equity investments as well.
This episode is brought to you by Uber. Courtesy transportation is no longer a nice to have, it's a need to have. That's why 80% of dealership respondents agree that providing on-demand courtesy rides with Uber has helped retain customers based on Uber's survey of 79 organizations in 2023. With Central, you can request a ride on behalf of your customers even if they don't have the Uber app. Car dealerships are loving Uber for Business because it's a headache-free solution for offering white glove service and seamlessly handling tasks like pickup and delivery of auto parts and replacing shuttles and loaner cars. Dealers can request one-way or round-trip rides, add multiple riders and locations, and even monitor trips in real time. Plus, you'll get monthly reports to keep track of everything. If you're ready to reduce the costs associated with maintaining shuttles and limit the liability of loaner vehicles, it's time to partner with Uber. Visit t.uber.com/CDG Auto today to learn more, or visit the link in the show notes below.
So here's something that's very interesting and near and dear to me. I think one of the biggest issues I had building a fast growth, auto retailer, had raised lots of capital, was distribution, or specifically customer acquisition. And, I pay attention to where the tech in our industry is headed, and just in general, technology, right? It's the marginal cost of building new technology is coming down very quickly, right? New products, new everything. I mean, you have a no-code tool for almost everything, right? Dealers that are integrating AI, they see the AI, it knows your customer's away on vacation and it pings them when they're back before you even woke up in the morning. I mean, things are getting serious very quickly and more efficient, right? But what I want to ask you is, what is your thoughts on what does it take to succeed as an auto tech business, right? Now and in the foreseeable future? Because in the 2010s, when I was just coming up in this industry and, getting acclimated, there was still so much product risk, right? You would build something and, is this the right product? I mean, just in general, like, does the product, can it find, market fit? It seems like today it's really distribution risk, or at least in a big part, right? Can you get your word out there? The world is increasingly noisy. Everyone is competing. I mean, money's sloshing, paid ads are more expensive than ever, and getting attention has become extremely difficult. So when you're making an investment, how are you balancing product risk versus distribution risk?
Wow, there's a lot in that question.
I had to come out heavy with this one because it's been sitting on my mind. I'm like, how does he think about distribution? It seems to me like, and I've done over 50 angel investments. It's like, I always think about distribution. I'm like, how are they going to get their word out there? The world is things have gotten so saturated that, cool, you can make an amazing product, but if no one knows about it, is it worth anything? How do you think about that?
Yeah. What's the book? I think it's called The Founder's Dilemma. I love that. They talk about, I think this is what you're describing, Yossi, is that they call it the chasm. So you have early adopters, and the early adopters will get you to maybe 5% share, maybe, if you're really good. And then there's this chasm that takes you to commercialization, like true scalability. And I think that's what you're talking about. And what they talk about in the book, that chasm is littered with, thousands of startups that look great for a while, but just couldn't sell at scale. So I think that's what you're talking about with distribution, is how do you commercialize at scale? So there's a lot that goes into that. Back to this theme of dealers investing, that's an amazing way to get if you're in dealer tech. And, I could take you through some of our close friends who, some pretty fancy names with folks that we like to learn from and collaborate with. If you get 3, 4, 5 of them piloting or using your product, I mean, let's face it, dealers have an insane amount of FOMO, us included, and people want to know, what are you doing, whether it's through a dealer 20 or whatever. if you can get pilots with some of those really key dealers and get champions there, that's going to be a great way to do it.
Smart. Build allies that are within the community. I'll tell you a secret. I even consider doing, I call it like a community round of funding for Car Dealership Guy, which, we haven't raised any institutional capital. We don't need to, but we just thought about it from, imagine if we can, quadruple our industry allies overnight. Right. So I think what you're saying, like doing these community rounds with whoever is your community, whoever is consuming your products, your content, whatever it may be. I just think it's a genius playbook to, build them as allies and then leverage them as resources.
So I'll give you a really specific one there too. And I'll talk about one of our portfolio companies, Orbi. We've made several investments in them. I'm on their board. I was a Tool's first board member, but this was their idea that we hosted. Let's bring together a workshop of current and prospective dealer groups. So we hosted this was probably about, I guess it was in February or March. We hosted 9 different dealer groups at our headquarters. It was the dealer and their chief marketing officer. Orbi's a dealer tech. They call themselves the middleware of dealership data. We hosted them and talked about here's what's new on the horizon. Here's what the roadmap is, but then a lot of what do you want to see? And it was a 24-hour period of just tremendous collaboration, sharing. Where do we need to take this? Where do we need to go? There's a really great way of getting just tons of momentum. We, at the time, we were using Orbi, but we had not yet committed for them to be our full customer data platform. We just announced that in the last, I believe, 60 days that Orbi now is our customer data platform. Atul would laugh. He'll laugh when he hears this. It took 3 years for us to do that. We vet these companies very strongly. Just because we've invested in them doesn't mean we're going to give them the keys to the kingdom. So that is a really good one with the workshops. But getting dealers involved is so important, just to be able to vet the product. There's another company right now that we're invested in, a company called VinQ. And we are using VinQ, but not fully deployed with them. And Chris and Danny and team are working on some deliverables that we've asked them to do. No doubt in my mind, they're going to deliver. They've already delivered 80-90% of it. But we will make them better. I think sometimes we drive them crazy in the beginning, but we're going to make them better, and they're going to make us better. So partnering with dealers, I mean, I think that's, the money you're going to spend in engineering and product development is worth way more than you're going to spend in advertising. And we're a big NADA fans, so I always encourage people to go to NADA, but do you need the big, Cox booth that, or zip code that they have? Probably not. There's other ways that you can get that type of exposure.
Mm-hmm. What do you think about, talk to me just a little bit about macro, EVs versus hybrids, autonomous vehicles, stuff like that. A little bit bigger picture. Are you investing in one theme versus the other? Do you think hybrids are just a stopgap and we're going to, rebound back to EVs? Or, like the past couple of years was EV craze and it kind of subsided. So what's your general take on those themes?
Yeah, so EVs, we'll talk about that first. First of all, we work with a lot of great manufacturers, but I think the stand that Toyota and Akio Toyoda, the very unpopular position that he took, well over a year ago, was the right one. And the fact that he said, not in these words, but in different words, we believe in EV, but EV is just one part of the solution for decarbonization. We 1000% believe in that. Will EVs at some point be 50% of the car park? Maybe. I don't know. Will they be more than that? Maybe. Will they be 100%? No. I don't see that. Maybe in 100 years, I don't know, but not in the next 15 or 20. So it's a part of the solution. Hybrids are a tremendous part of the solution. And so should that be part of it? Will hydrogen, I'm not smart enough to know if hydrogen is going to be 2% or 20%. But I think hydrogen is going to play. The fuel cell is going to play a role here too. So there's more than one path to decarbonization, is what we would say. From our standpoint, we made a small investment in Rivian. Obviously, if you followed Rivian, we looked really smart for a while because it was hard to get in on Rivian, and then maybe not so smart after a while. That's what happens at times with these investments. We still believe in Rivian. We think they're going to be great. But we don't necessarily want to invest in hardware and manufacturing. So we've made investments in software charging solutions. So there's a couple of companies in that space that we use both on the fleet side and a little bit on the retail side now as well. Will we swing for the fences at times? Yes, but we're more the like the great gold rush. Do we always go for the gold? Well, there's a lot of people that made a lot of money in the picks and shovels and the jeans along the way. So we'll do some of those software supporting businesses or tech-enabled businesses where it'll help us and help our customers. Again, not quite as sexy as, investing a bunch of money in Tesla as a startup or Rivian, but we like that because that's what we do. We're a solutions provider and a systems provider for our customers.
I'm wondering, do you think that competition in software, we're just coming to an end? Like, is new software and startups, is that a dying breed? Are we going to see a future where it's just an oligopoly? You have 3 to 4 players who are controlling every piece of software. Because look, right now, there are lots of new AI entrants and tools, right? But it's really dispersed. There's lots of different tools for different products. I actually spoke about this the other day with Devin, the CEO of Impel, and I asked him a similar question. I said, are we going to see a future where, several companies have 5 different AI tools that operate in your service department, your sales department, your BDC, your F&I, or are we going to see a bunch of different vendors? So what do you see for the future of auto tech, right? Is this going to be an oligopoly, or are we going to have more new entrants entering the market and being able to succeed in light of, being disadvantaged, fewer resources, less distribution and stuff like that?
As long as the capital is flowing, I believe there will still be a healthy market for startups and folks to innovate things that the major players could do, but they just have so much on their plate. We know this. We started off 100 years ago with a single point Ford store, and here we are now, 60 dealerships, and that's just one part of our business. It's really, really hard to innovate in the core of any business. So, can the major players, everybody looks at the DMS providers, can they do that? There's other companies, you look at some of the aggregators, S&P, look what they've done here in the last 5, 6, 7 years and the acquisitions they've made in aggregating these businesses. Look at what Cox has done over the last 12 years, I would say, in doing that. So would they be part of the oligopoly you're talking about? Sure. However, I think there's still going to be a place for innovation for new businesses. Again, it is so hard for those companies to innovate, and whether you call them entrepreneurs or whatever you call it, Cox had those programs. We built some platforms. That's when I had those developers all working for me. We built 3 different platforms, one of which we sold off the lift, a subscription platform that's done very well for them. It's hard. It's really hard. And, we often say we have to be really careful about wanting to buy a startup because we like to think we're a pretty good company, but we'll ruin it. We'll make it corporate, we'll Holmanize it and make it corporate. And that's just not the lifeblood of a startup. So I think you'll still see those startups. Maybe your question more is, is there room for a company that's 100 million top line, 200 million top line versus billions? I do believe they will continue to be acquired by some of the major players.
Do you think this is a net positive for dealers, consumers, both?
It should be a good thing. I know some of those players, as smart as they are, and they're very smart, they still work with stitching together the data and the applications so we don't have 11 sign-ons. Let's face it, it's still so clunky. It's a nightmare. I went with clunky. You went with nightmare. I'll go with you.
And now taking it a step further, what do you think are the biggest risks that dealers face? Like, are we facing an existential risk for the industry? Do you feel that way? Again, you have skin in the game here, 60 stores. What goes through your mind?
Yeah, when you look at the threats over the years, dealerships, dealers survive because there's a lot of entrepreneurial, small business entrepreneurial momentum and just, can-do attitude. I would say one of the big things, will the agency model come to the United States? The agency model sounds really good in periods of low inventory, not so good and I'm talking through the OE lens, not so attractive when you have a bunch of inventory because they own the inventory.
Yeah. So just to define this for the audience, right? You're referring to OEMs, physically holding and storing inventory on their balance sheets, as opposed to offloading it to dealers, which is typically when they book that profit. Blurring the lines a little bit of what traditionally a whole manufacturer is versus a retailer, and it's pretty controversial because you're as a manufacturer, you're starting to step on toes of dealers. You're creeping into the retailing, and you're compressing the margins for the dealer essentially, or that's at least if you're an OEM, that's what you would just be capturing more value. The dealer would be capturing less value, and dealer's margin starts to wither away. So I just wanted to define that.
Yeah, and just to add to that quickly, it's I always say the best way to define it. You gave the asset side. On the transaction side, the OE now transacts directly with the consumer. That's the single biggest difference, other than what you described. So dealers become a sales fulfillment. We deliver the car, we wash the car, we do the F&I, we do all that, but the transaction is between the customer and the dealer. That's the biggest difference. And then our margin really becomes, what will the OEs pay us to handle that for them? We've done a lot of work on that. Can you still make money in that model as a dealer? Yeah, you can. We think that it's much better for a dealer to transact directly with the consumer than the OE. So we are very much supporters of the current model. But is it an existential threat? It would be. The likelihood of it happening in throughout the U.S., I believe, is not a high likelihood. By the way, for your listeners, that is the dominant model through Europe is the agency model. So we'll see where that goes. I'll tell you the very real threat, and we literally just had a day of meetings where we brought Matt Newford, who leads the Amazon retailing platform. Tremendous guy, super smart, as you would expect. And, we set it up as, are you guys a friend or foe? Are you going to be a partner or a threat to dealerships? They're working really hard to position as a partner with dealerships. Many of your listeners will, know that Hyundai has a pilot going with them right now in conjunction with Hyundai dealers. But, when you fast forward, and we talked about this with Matt, Amazon doesn't do things to make dollars that start with M's. Everything starts with B's and a whole lot of billions. Where does that money come from? Is it come from margins? Can you introduce another player that wants billions into our sales channel right now? I don't know how you do that. Matt has said publicly that they intend to have revenue that comes from advertising. So think about it this way: a dealer right now, we advertise with all these different sources. Digital, most traditional is way down, but all the digital plays. Well, now you can give all that advertising to Amazon, and on our platform, all the hundreds of millions of eyeballs, you will have them at your dealership. That makes some sense. I haven't done the full math on all that, but that is a fundamental value proposition that Amazon has. They own that property. So what will that look like in the future? That was one of the questions I said to Matt. 7 years from now, let's say you own 40% of the new vehicle new vehicles sold in the United States. What does that look like for dealers? That gets a little scary. And again, they're super smart, and we're staying close to them because when Amazon knocks on your door, you don't put your head in the sand. You talk to them. So a lot of dealers think it's an existential threat. We're still evaluating what that looks like.
We'll have to get them for a conversation.
You should. Happy to put you in touch with him. And Matt's a brilliant guy. You would enjoy it.
That's great. A little bit more lighthearted, but how do you get deal flow? What's your secret? How'd you get your name out there? Because again, you weren't grown in, the VC business. You grew into dealership operations. So how do you get your name out there nowadays?
Yeah, great question. And it really started with 7-8 years ago. We obviously have a little head start because we have a ton of relationships, and I, with my experience, know a lot of people in the business. So I just start jumping on planes and meeting with people. We early on started off with as I guess we coined the phrase, we wanted to know what the smart minds were thinking and where the smart money was investing. So we talked to a lot of the, McKinsey's, Deloitte's, PwC's, all them. We started talking to a bunch of private equity, to venture capital. I happened to be introduced to Chase Frazier and Mark Norman. They were tremendously helpful, helping me early on. And my agreement with Chase and Mark always was, and still is to this day, I want to, on a monthly basis, go through all your deal flow with my team. We have a team of 7 investment professionals, and we work with their team. What are you looking at? What do you like? What don't you like? That's been tremendously helpful, and I would recommend that to others to do the same. Beyond that, we started going to shows and conventions that we would never go to in the past. So there's a great one, Global Corporate Venturing Group. They have these throughout the world. We just started going there and talking to people, and we said, "Hey, look, we know how to run
business." Got your name out there.
Yeah, we did. And here's what I found out. See, the fun part of venture is people. It's a team sport. It's not like private equity where one person wins. In venture,
sum.
It is a positive sum.
I totally agree with you. That was the biggest, that was the weirdest thing for me in this industry, that, you get used to the car business, which in many instances is super zero sum, right? You're at an auction, like either you win or I win. Like it's not we win together. Suddenly you're exposed to this world. It's like, hey, I'm going to win. And the more I win, the more you win. And the more you win, the more I win. It's pretty remarkable.
It is. And it's a lot of fun. I mean, it's a whole lot of fun. So we, for instance, some of the ones I told you about, think about it. CarMax is a competitor to Holman Retail, correct? I mean, you don't have to be a genius to know that. I mean, they sell used cars literally. There's one about a mile from my office here, and I got a dealership right in our backyard. They're a competitor. Well, CarMax is one of our closest friends and confidants on investing. We've invested in 3 companies. I don't want to say together, they're separate investments, but we'll call Terrence and his team and say, "Hey, what do you think of these guys?" And we compare notes. There's one company that we invested in with CarMax and with Assurant Ventures, the big insurance company. And this company, Treehouse, is going to get a lot of business from the 3 of us. And we think they're going to do very well because of it. We love that. There's a term, do you club up? Do you do something together through an SPV, or you do it separate? Whatever it is, I just want really strong investors. Financial VCs are great. The corporate ones are even better because they can give ARR. So we're always looking at the cap tables, who's on there. We're calling them. Once the flywheel started, oh my goodness, it just accelerates. The other thing we did, we just started this 3 years ago. We actually put on our own conference we call Home and Emerge. I need to invite you, by the way. I'm just meeting you recently, so we'll have you come. I would love to get you up on stage with me. We'll reverse it. I'll interview you for that one. But we just had over 200 people show up for that. It was 38 startups were represented. We had, oh my goodness, 40 different investors, billions of assets under management. A lot of these people I'm talking about were all there on stage. Holman, we don't charge for it because what we want to do is just convene really smart people, smart minds. Deals are done there. So that's been just the last 3 years once we got the flywheel going. So it's fun. We'll look at 600 names a year. We'll talk to roughly 230 like separate meetings with startups, and we'll invest in 5. So I like to say in venture, a lot of nice people, but you learn to say no very nicely a whole bunch of times. And a lot of times the no's are just not yet. It's a not yet with the no's.
And speaking of events, I'm hoping to see you at my NADA party during NADA, of course. So we're hosting a private party on Friday. It's going to be it should be great. So I'm really looking forward to that.
Can't wait.
Tell me about biggest mentor in venture. Curious, how did you learn all this, right? So you had the resources, the network, but again, learning, it's a whole industry. You could write, many books, and many people have, and some people take decades to do this. So how did you get into this, or who mentored you? Was there someone specific that you can point to?
Yeah. So I'm going to give you a company. I'm going to give you 2 answers if that's okay. And I say this often. The company that was like our big brother when we started was Cox. Sandy Schwartz, who I just think the world of. He's one of my favorite human beings on the planet. I'd gotten to know Sandy a little bit, and Sandy said, "Hey, man, we're doing this in spades." If you know Sandy, he says, "Look, we're not doing everything right. We think we're doing a lot of things well, but Bill, let's collaborate." We literally spent better part of 6 months, my team and Cox's new ventures team. And we did a full open kimono. What are you guys doing? What are we doing? All your business models, and then what should we invest in based off that? Should we build platforms together, which we did invest in FlexDrive together. So they were incredibly helpful for us. They were probably 2 to 3 years ahead of us in that whole venture space. So I would say that was by far the single biggest accelerant to what we did. And then, going back, my good friend Chase Frazier has been just a tremendous help. Again, that was my deal early on, is if I'm going to put money and be an LP, put money in your fund, you're going to teach me this business. And Chase and his partner, Mark, they're I don't use that term lightly. They're both very good friends and now equity partners. They helped teach me the business. That I always say it's equal opportunity, though. There's some other great players that I've become affiliated with. Chris Cheever from Fontanalis is one of my favorite people in the business, super bright. He's helped tremendously. I could go on for others as well, but that would probably be the ones that really helped us accelerate our path.
Very interesting. Bill, before we wrap up, I'm curious to know, what do you see as the biggest challenge facing the industry over the next 3, 6, 9 months? And what I'm referring to here is, affordability, right? Financeability. We're going through this pretty awkward stage right now. Delinquencies are rising. They're higher than 2019 at this point. Things have just been pretty rocky. Some people saying recession, interest rates now starting to come down, which is, again, I'm not an economist by any means, so discount this, but historically, it can be indicative of the beginning of, maybe a pullback in the economy. All that said, what do you think are the biggest challenges facing our industry over, the next kind of 3, 6, 9 months?
Yeah, I think it's really, you hit the nail on the head, Yossi, and I'm not an economist either, but we study it a lot. I would say it's macroeconomics right now. The industry is healthy. I mean, you could say grosses are dropping. Well, they're coming back to normal. Supply and demand dictates that. So we all knew that was going to happen. Overall, I always say when times are really tough, and I've been in this business a long time, or something crazy happens, people go, "Oh my goodness, people aren't going to buy cars anymore." And I go, the American consumer loves to buy stuff. They will buy things. If they don't feel wealthy, and I believe there's going to become it's not going to be a disaster, but people are going to feel significantly less wealthy when home prices start to moderate a little bit, and I can't take a home equity line. I think the stock market.
You think people will feel less wealthy than they feel even now?
Yes, I do. I do. And I was just listening on Bloomberg the other day, and they're talking about, basically all that TARP money. I'm sorry, TARP money. All that, the money that came out of COVID. I'm going back to 2009.
Yeah,
All the
you're
money.
going 09.
I'm going, yeah, that was a corporate money. All the consumer money that was put out there, all the stimulus money that was put
It's
out
gone.
there,
It's been gone. Yeah.
it's gone. From a macro standpoint, we're heading for some softening right now. It's going to come back to normal. I don't think it's going to be a major recession, but it's just, this happens about every 10 to 12 years. So, we're going to get through this. I hope people continue to invest in technology through that, and continue to invest in everything we do as dealers. So I would say that's just more of a seasonal piece. The one thing that I would say is probably more systemic, which is going to be interesting, is the consolidation of dealership owners. I think it's a good thing. It's been happening a lot, and I think it'll continue to happen, but that's just going to be one for us all to watch. Will the publics continue to be acquisitive? That's what they do as a public dealer group. They're there to sell cars and run dealerships. Will the large privately held groups continue to acquire? We like the dealership business. We're going to be in on that. And then I would just leave it with the third piece is, will the kind of, I don't want to say quasi-private equity, but will that money and family office money continue to invest in dealerships? That's going to be a really interesting one to watch. There's some very much under the radar families that have acquired dozens, in some case up to in the hundreds of dealerships. And what does that look like in the future? I don't have the answer to that. I know Holman's going to be part of it, that's for sure, but it's going to be interesting to see how that plays in the future.
Fascinating. Bill, thank you so much for coming on. Any closing thoughts as we wrap up?
No, I was just saying, this is, all dealers say this, but all dealers mean it. We love this business. It's just great to be in the business. It's, running dealerships. It's, I would say it's a grind, but it's a fun grind. And so we love the business, and we're looking to grow. Love talking to people like you. So, been a lot of fun. Thanks for having me on. It's a privilege and an honor. So thank you.
One of the craziest things about the Car Dealership Guy platform is our direct access to literally thousands of dealership and automotive employees. So naturally, I often hear this question: CDG, can you use your network to help me fill an open role at my company? Well, now I can. Building on the success of my free industry job board, I'm proud to launch CDG Recruiting, a more hands-on white glove automotive recruiting service. Whether you're looking to fill roles in dealership management, C-suite, F&I, fixed ops, auto tech, SaaS, we take the hassle out of hiring by doing the heavy lifting for you. And here's the best part: we vet and screen thousands of candidates so you don't have to. And with our placement guarantee, hiring through CDG Recruiting is 100% worry-free. Our team has decades of experience and has successfully placed over 1,000 roles in the automotive industry. So if you're ready to find your next rockstar employee, try CDG Recruiting today by visiting cdgrecruiting.com or clicking the link in the show notes below. Again, that's cdgrecruiting.com.
All right. Hope you enjoyed that episode. Please give the podcast a rating, consider subscribing to the show, and check the show notes for links to what we talked about. Thanks for tuning in. I'll see you guys next time.